If you want to emulate the success and global recognition of Warren Buffett, you need to understand how he achieved his fortune. Buffett spends countless hours researching a variety of companies, from energy to fast food and beyond, before investing or making any kind of decision related to stocks. He is always on top of the latest news, calculating potential outcomes for different investments, and staying ahead of the competition. He has also mastered the art of predicting trends in stock markets by studying past performances and analyzing future potentials. Welcome to Financial Psychology. In this video, we'll share with you 7 of the only rules that you need to know to achieve success, guided by Warren Buffett's legendary investing career that enabled him to amass a personal fortune of more than $83 billion. From his early investments in big blue chips to his more recent foray into tech stocks, these 7 principles are the cornerstone of Buffett's success and provide valuable insight for all investors. So let's dive in and get started. Rule number 1. Hire smart people and understand investor behavior. Warren Buffett is one of the most successful investors in the world, and this success is based on 2 main factors: hiring smart people and understanding investor behavior. When it comes to building a successful investing business, Warren Buffett knows that having a team of knowledgeable and experienced professionals is key. He himself has said, "It takes 20 years to build a reputation and 5 minutes to ruin it." If you think about that, you'll do things differently. This means that Warren Buffett carefully vets his team of employees to make sure they have the necessary skill set and experience to help him build his success. Warren Buffett also credits his success to his insight into investor behavior. He understands how fear can affect decisions, how markets move in cycles, how speculation can impact stock prices, and how news events can influence investors' opinions. By understanding these dynamics, he is able to make sound investments at the right time and avoid making costly mistakes that could negatively impact his portfolio. Rule number 2. Buy cheap stocks by looking for cigar butts with one puff left. One of the most influential lessons Warren Buffett learned from Ben Graham was to buy cigar butt stocks. Stocks with one puff left, or stocks that have been beaten down and appear to offer little or no potential for capital growth. This refers to stocks that could be purchased very cheaply in comparison to the company's underlying assets, allowing Buffett to buy them and hold on until their true value was realized. The strategy of buying these types of cheap stocks was a cornerstone of Warren Buffett's approach, and one he stuck with throughout his career. He took it further by examining the companies more closely and looking beyond financials, paying particular attention to management, competitor strength, and industry cycles. He used this comprehensive approach to ferret out any potentially lucrative investments that may have been overlooked by others. In other words, he looked for companies that were undervalued compared to its book value or price-to-earnings ratio, had strong underlying assets, experienced management teams at the helm, operated in industries with growth potential, and had a good track record in terms of financial results. By following this strategy, Buffett was able to purchase stock when it was undervalued and turn a profit as these assets continued to increase in value. Rule number 3. Buy a great business at a fair price and understand its economics for the long term. The third rule is perhaps one of the most important keys to Warren Buffett's success. He is always focused on buying a great business at a fair price, and more importantly, keeping it for the long term. He's been known to say, "If you don't understand the economics of what you are buying, you probably shouldn't be buying it." Indeed, if you find a great business at a fair price and don't understand its economics in the long term, then you may find yourself stuck with an already deteriorating asset. Instead, focus on doing your research beforehand and look for companies that show promise in terms of their potential for sustained growth in the future. Look for companies with competitive advantages, such as patents or unique products that can help set them apart from competitors. Also look for companies with strong management teams and good governance practices to ensure that your investment is safe over time. Rule number 4. Take advantage of opportunities within your circle of competence. One of Warren Buffett's most profound quotes is this: "Risk comes from not knowing what you're doing." In other words, investing mistakes are often made by not taking advantage of opportunities within one's circle of competence. By researching stocks thoroughly and understanding the industry trends within your area of expertise, you can make smarter investments that have a higher likelihood of generating returns. Take time to learn the fundamentals of investing, like understanding the market capitalization and dividends, and then use that knowledge to hone in on promising stocks. It's important to remember that no investment is risk-free, so take the time to do your research and build a diversified portfolio with companies in multiple industries. This way, you can still benefit from market swings without being too exposed to any particular sector. Investing with the mindset of Buffett will ultimately lead to more success because it combines sound principles with logic-based decisions. Rule number 5. Seize big opportunities, but use financial decisions wisely. When looking to seize big opportunities like Buffett, it's important to also make sure that your financial decisions are wise ones. Look for 3 in 10 odds of success. Instead of going for the grand slam all the time, look for opportunities where the odds of success are reasonably good. Take note of risks and rewards. Understand the potential reward if you succeed, as well as potential loss if you don't. Make sure your research is thorough. Don't go into any opportunity without doing due diligence first. Exercise patience. Don't think you have to jump on every opportunity as soon as it presents itself. Assess each one properly before making a move. Understand your risk tolerance. Know and understand yourself and how much risk you are willing to take on before jumping into an opportunity. Weigh up each decision carefully. Take the time to understand different outcomes with different scenarios and choose wisely based on what data or expertise you have access to. Before we proceed further, kindly take a moment to hit that subscribe button and turn on your notification to stay updated on our latest videos. Rule number 6. Calculate a company's intrinsic value by predicting its cash flows and discounting them. According to Warren Buffett, one of the core principles of investing is to always know the intrinsic value of a company before investing in it. The way to do this is by predicting the cash flows that a company is expected to generate over the course of its lifetime and discounting them to arrive at their present value. This process is known as discounted cash flow analysis. When applied properly, will give you an accurate picture of a company's true worth and allow you to determine if it is worth investing in. One key factor to note is that when calculating the cash flows, you must take into account external factors such as inflation and new regulations, so that your estimates are as accurate as possible. By following this rule, you can ensure that you are not overpaying for a stock and instead investing at its true value. With this knowledge in hand, you can confidently invest in stocks without worrying about being taken advantage of by manipulative stock prices or unsound investments. Rule number 7. Only sell investments if discouraged or business changes significantly. When it comes to selling investments, Warren Buffett has a set of hard and fast rules that can help you avoid costly mistakes. Firstly, only sell an investment if you become truly discouraged about the business, or if its prospects change significantly. This helps to protect your capital and determine when to cut your losses. Furthermore, Buffett recommends that you should not get caught up in the daily market volatility. Instead, stay focused on the long-term plans and investments that are aligned with your goals. In addition, you will want to be aware of the distractions coming from stock news and other sources that can cause rash decisions during times of panic. It's best to remember why you invested in a company in the first place before parting with any stocks. By investing in Berkshire Hathaway, Warren will yield returns over the long term. When asked about his investment strategy, Warren Buffett once said that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, and it's clear why. Investing in Berkshire Hathaway, Warren's parent company, was a great way to realize returns over the long term. So, if you are looking for a way to grow your wealth with minimal risk, Warren Buffett's rulebook is a great start. Take the time to understand the strategies of the Oracle of Omaha, and you can start investing with confidence. Kindly let us know your opinions in the comments section below. Don't hesitate to like this video and subscribe to our channel to see more videos like this.